Hello, folks. Feel free to let us know where you are joining from in the chat. I know Adam is joining from Lake Tahoe. Daniel, I didn't actually ask you, whereabouts are you joining us from today?
I'm joining you from Miami.
Nice. Lovely. Miami is on my list of destinations. Kevin on our team is actually trying to get me signed up for the marathon in Miami in January, but I'm not entirely sold on that.
Just avoid Miami now until maybe October. It's way too hot.
Oh, yeah? What are we talking?
About 2 blocks to the store and I'm sweating, drenched.
Yeah, okay, fair. I'll hang off until winter then, for sure. Cool. So we've definitely got a good mixture of people from all over. North Carolina, New Jersey, Cape May, Colorado Springs, LA. I didn't see Miami yet, but no one else representing just yet. Well, I'm sure they'll filter in. I'm sure all your friends and family join in too, Daniel, at some point. Cool. So I'm going to just get this started now. We've got a decent amount of people here, and I have to do the typical housekeeping at the start. So thank you everyone for joining us today. This is our monthly masterclass session that we like to do. We get a couple of different people on to present kind of their thought leadership. Today's session is obviously around financing your short-term rental in 2023. Just before we begin, a couple of housekeeping notes, as I mentioned. So today's session is being live streamed. So if you fall off at any point, lose your Zoom connection, you can head over to YouTube and you can check out the session there. We'll also be recording, so you can check it out on YouTube, as I said, but we'll also email that across after the session, probably tomorrow morning when we get that email out. We're going to start today's masterclass with a couple of pre-prepared questions from us at the Hospitable team to Daniel and Adam, and then we'll move on to some audience Q&A. You can use the Q&A functionality at the bottom to kind of type in your questions. We'll also give you a chance to raise your hand at the end if you prefer to come on stage and ask your question live. So I think that's it, mostly from me and the general housekeeping notes. So thank you everyone for joining, as I said. My name is Miles Hobson, by the way. I am the head of marketing here at Hospitable. Hospitable gives short-term rental hosts their valuable time back. Founded in 2016, Hospitable tools allows hosts to automate their short-term rental management. If you want to find out more about us, you can go to hospitable.com. But let's get over to Adam and Daniel now and let them give a little bit of an introduction to Host Financial and themselves. So Adam, Daniel, don't know who wants to go first. Fire away.
My name is Daniel Ramirez. I am from Concord, California, moved to San Diego, and now live in Miami. We started Host Financial in 2018 as a solution to our own problem. I sold a company in 2018, and from there was looking, what's the next chapter for me? I dabbled in short-term rentals and always been interested in it. And what I found from a conventional standpoint, financing with a conventional standpoint, that as a lifetime entrepreneur without any traditional underwritable W-2s, it was difficult. So we found a solution to our own problem and started a company around that.
Yeah, Dan and I both lived in San Diego at the time. And like Dan said, we just kind of started looking at some of the challenges around financing short-term rentals, especially if you don't have that more traditional W-2 kind of based income. My background is in real estate development, and that's what I was doing at the time in San Diego. And as we kind of, started looking at these different short-term rental deals, I'm looking at them from a developer's perspective, and the returns generally are really strong and really, really good compared to, an alternative long-term rental strategy. And you kind of couple that with the fact that financing is pretty difficult, or was even more difficult at that time. It just seemed like there was an opportunity to kind of build a business around, solving that financing issue that a lot of short-term rental investors and short-term rental hosts were encountering at the time and still encountering.
Cool, awesome. And so is Host Financial kind of really focused only on short-term rental financing, or do you kind of look at, the range of the spectrum, shall I say?
Yeah, I mean, investors are I think not any one investor typically has one asset class they invest in. So we try to offer the full suite, tailored specifically to, investors, not second homes, not primary. So what that means is, yes, we do short-term rentals. That's about 90% of our deals, but we do underwrite long-term rental deals and offer renovation and new construction financing, as well as the takeouts from those hard money loans into maybe a perm loan, whether it's long-term rental or short-term rental.
Okay, cool. And then as you say, kind of investors are interested in kind of either or to some degree. But when it comes to kind of getting financing, is there any major differences for, me or someone else wanting to be a short-term rental host? Is there a major difference between financing a short-term rental or a long-term rental? Is there some major differences we need to be thinking about when we're going out in search of that money, essentially?
Yeah, I mean, I'd say that, there's a lot more lenders out there that are more familiar with how to underwrite long-term rentals than short-term rentals. Short-term rentals have just been around for a lot less time. So it's really important to kind of understand and make sure that the lenders that you're working with truly understand short-term rentals and how those are underwritten and how that underwriting differs from a more traditional long-term rental type of investment, because there are differences in how you treat the income, differences in how the leverages and the rates are determined. So it is really important that whoever you work with make sure that they understand the short-term rental space and how those loans, the underwriting differs from long-term rentals.
Okay, interesting. And so, definitely differences in kind of underwriting, as you say. What's kind of the benefit invested in short-term rentals? What's the kind of main, draw you see people, wanting to invest in that space? Why do people say that they're choosing short-term over long-term?
I think the upside, the benefits is the flexibility of it and the upside of the cash flow. That's typically what draws people to short-term rentals. They kind of expect it to be a passive investment, just spitting out a bunch of cash. Obviously, it's a lot harder than that, and it's getting harder every year with increased competition. But you kind of know what you're going to get with a long-term rental. That maxes out to a certain extent. However, if you are a short-term rental operator, you have some confidence in yourself in marketing a property and outperforming other people in the space, there is significant upside in terms of cash flow. And then on the flip side, there is the backup plan. Say the market does support long-term rents or long-term renters. If the short-term rental doesn't work out, you always have long-term rent as a plan B.
Yeah, we've seen investors kind of employ, that hybrid strategy that Dan was talking about, and that flexibility, depending on it's obviously all real estate's very market dependent. But there are hosts that have a strategy of splitting up their rental strategy, a portion being short-term rental and a portion maybe even being a mid-term rental, which is a new emerging strategy that's coming out, where they can, if you're in a highly seasonal area, you can short-term rent during the peak season and then potentially flip over to a more medium-term rental strategy on the off season. So I think that's a big draw. Why people get into short-term rentals is obviously the revenue upside, but the flexibility to kind of pivot around and take advantage of the different strategies that work best for different periods of the year.
Yeah, for sure. And I guess, certain different regions mean different strategies as well, right? So I'm trying to pick out a destination without kind of offending a state now, but there's certain destinations that aren't vacation. Go for it.
Yeah,
You're on offend.
So I grew up in Arizona, so I have a house in Phoenix. So Phoenix is a perfect market, right? The winter months, that's peak season. That's when most people are there. It lends itself very well, spring and winter, to a short-term rental type strategy. And then in the summertime, when it's all in the news right now, it's just insanely hot. You could still utilize a midterm rental strategy depending on the property you have, because even though it's 118 degrees outside, there are traveling nurses and corporate rentals and things like that still have to be filled regardless of, how hot it is in Phoenix in the summer. So that's like kind of a perfect example of a market where, you could kind of take advantage of both of those different rental strategies and optimize the cash flow for the property, even more so than if it was just 100% long-term or 100% short-term.
Nice. Yeah. And then kind of really going back to, when you were answering Daniel, you kind of touched on the fact that there's an increased competition in the market in short-term rentals. Is that you seeing that in your data, or is it just kind of, the wider narrative that we're seeing? Are you able to see yourself there's increased demand in financing for short-term rental in the past year or so?
I would say that statement comes from some anecdotal evidence from investors I'm in contact with that own portfolios, and then also paired with some data from sites like AirDNA. They've released a lot of good data. So I believe we're in somewhat of a shakeout period. I think we had some anomaly years with 2020 and 2021, which had an opposite effect of what people predicted was going to happen. They expected the Airbnb market, or excuse me, short-term rental market to be hit significantly. And it was the opposite. People were leaving urban destinations, going to, stay in different cities, stay in these drive-away destinations. It also emerged the work from home business traveler. A lot more of those came about. And now the pendulum swinging the other way. These places like Joshua Tree, drive-away destinations, a lot of people entered the market expecting it to stay frothy, and the pendulum swinging the other way. And along with that, there's, because it was so frothy, a lot of people are entering the market thinking it's going to be easy money. And it really is. It's not easy money. There's a way to do it right. There's a way to outcompete, but you have to be smart about it. You have to be a diligent investor. And I would say that the pendulum, swung. It's kind of coming back with the urban markets, but it's more of just a shakeout period. I mean, where smarter money's coming in, and they're going to be, if you can't be doing this as a hobby anymore. So you have to compete. And that's just the natural maturation of any market. There's the early adopters, the people that make fast, easy money, and then it matures. There's increased competition. There's a shakeout period, and only the strong survive.
Okay, cool. So to be kind of a mature and sensible kind of investor, putting your kind of smart hat on, what are some of the metrics that you need to be looking at to making those decisions on what a sensible investment is? We don't want to go in guns blazing. We don't want to just, hey, short-term rentals is fantastic. Let's get as many properties as we can. What are some of the metrics we should be looking at to kind of make that sensible decision on should we get that property and should we make that investment?
Yeah, I mean, I think, what's really important, kind of like alluding to what Dan was saying, is that I think a lot of people got in looking at, 2020 or 2021 numbers, anticipating that those kind of elevated income figures would continue, not really realizing that it was somewhat artificially, not somewhat, but very directly artificially inflated because of the increased demand that COVID created.
Mm-hmm.
So taking an underwriting, if you want to look at any specific property, going back to what would be considered more typical demand years like 2019, and looking at those revenue figures and using those to kind of do your preliminary underwriting, I think that's a pretty prudent thing to do. And then also making sure you're stress testing any of your underwriting, just to make sure if you do have, an increased capital expenditure, right? AC breaks, or you got to, fix underground pipe, whatever it may be, or you have an anomaly month or two where demand is down for, could be any number of different reasons, making sure that you've really taken a hard look at those revenue figures and make sure that they're, sufficient enough to meet whatever your return goals are. I mean, that's where it kind of gets to each individual investor. Each investor A may be looking for like a 15% cash on cash return, and investor B may need a 20% to make a deal work. So you want to make sure that you're stressing your own internal assumptions, and kind of doing a base case, worst case, best case type analysis, and making sure you're kind of going into it with all those different factors considered.
Yeah. And then also in addition to that, what's your plan B? Say short-term rental is not the investment for you, or the market is not, takes a hit, the travel market takes a hit for whatever reason. Can you plug in, what are the numbers for long-term rental, and can you plug that in and still either cover the note, or does it cover enough that your cash flow out from other investments can come in to where you're not defaulting on a property? In addition to metrics to look at, I would say, there's a lot of different metrics out there in terms of like occupancy rates, yearly revenue, average daily revenue. I would say your monthly revenue, projected monthly, yearly revenue is more important than occupancy, because you could say, hey, it's 75% occupancy rate in this market, or 99%, but at what dollar per night are you charging to get that occupancy rate? And is that going to, produce the kind of revenue to cover the note? And if not, then yeah, you have to look at the yearly revenue most importantly.
Nice. And then you kind of, you sort of maybe alluded to it there a bit. You kind of talked about having other investments to kind of cover you if the short-term rental market kind of goes bust for a period. So I guess, as with all investments, it's kind of important. Diversification is kind of a good idea, I assume.
Yeah, I mean, yeah, you want to be. There's a number of different strategies, and every investor is different. But I think generally being geographically diversified in your investment portfolio helps hedge against having individual localized market downturns. I think that's very important. Diversifying the type of properties and the type of targeted, specifically for short-term rentals, targeted travelers that you're going after. I think that helps kind of spread the risk around. If you're all into mountain towns in one specific mountain town and there's a wildfire there, obviously that's going to impact your overall portfolio. But if you've got your investments spread across diverse geographies, then you've kind of mitigated that risk a little bit. And then, I mean, I always think it's good to look at each individual investment and make sure it can stand on its own, so that the cash flow of that specific property is sufficient to support that investment. But it is good if you have a broader portfolio, being able to, potentially shift funds around if for one reason there is a downturn in one specific market. But again, it's all going to be dependent on each individual investor's strategy and portfolio and their whole position.
Okay. And I guess, no matter which property it is for you, in terms of like property number 1, property number 5, property number 10, whatever, the same strategy is probably going to be followed. The same best practice tips should kind of really stand true. Looking at diversifying based on location as you grow, and obviously again looking at occupancy, but also revenue over the year. No matter which number of property it is, I guess it doesn't matter, right? The same holds true.
Yeah, I mean, I think the same principles are the same, whether it's your first property or your 10th property. Obviously, just the analysis changes when you've got a larger portfolio, because you do have, I guess, more revenue that you can pull. But again, I always think it's important to make sure you look at each individual investment, make sure it can stand on its own from like a return and performance perspective. So yeah, I don't really think that there's from a high level that you would change your decision making between first property or 10th property.
Cool. And then you've kind of given us the best practice tips, but what are some of the things you see people doing wrong when it comes to trying to finance, or kind of get their investment? What are some common stumbling blocks or mistakes people make that they should kind of watch out for?
Yeah, one of the more obvious ones that I've seen is the first-time investor being overly optimistic on that. They're going to furnish the house and they're just going to hit the ground running with the expected revenue projections that, say, a Rabu or an AirDNA might spit out, and really not having the reserves to cover, that potentially slow ramp-up period while you figure it out, while you figure out your formula, while you figure out your market, and to really hit those numbers. And, it's a lot of work. You have to furnish the place, especially if you're building a new listing and you don't have any reviews, that's going to, be less likely to show up on OTMs. While you figure out how to capture and remarket to existing clientele, there's a ramp up period, and you need to have the cash reserves to carry over the potentially first few months that might be slow.
Awesome. Adam, any ideas to add to that? Things.
Yeah, I mean, no, I think Dan hit it. That's a big one. People assume the projections are going to say you're going to do $250,000 in a year, but if it's your first property or it's in a market you're not familiar with, you don't automatically start generating that fully loaded rate day one. You've got to ramp that period up. Another thing I think people underestimate is really the cost that it takes to properly furnish and decorate short-term rentals. I mean, it's getting to the point, getting back to the whole, market getting more competitive. You really have to have something unique about your property that's going to drive interest over the other properties that are available in the area, whether it's really interesting and creative design, or whether it's a location that's going to demand a higher occupancy or higher daily rate. So I think people underestimate really what those, kind of initial setup costs are to really create something unique that's going to drive the interest. And then, having a healthy enough reserve for any type of capital expenditures that are going to be made, because just by the nature of short-term rentals, they get more use, more turnover, just more bodies go through them, on a daily, monthly, whatever basis. So things break all the time, and you've got to replace those items. And I don't know, it's a stumbling block, not accounting for either a reserve that's built in up front or some of the revenues that you're generating on the ongoing operations, setting aside a portion of that into a reserve CapEx repair fund. Those are some things that I think a lot of people more new to the short-term rental business often miss.
Yeah. And to touch on a little bit of what Adam said, there's two things that people do. They come in with some bias. And I always say, check your bias, and you don't have to reinvent the wheel to compete. So, you might want to stay in a very modern style luxury home, but is that what performing at that market? Say it's a new market, and you don't travel there yourself, but the numbers say it looks good, and you want to enter that market. Look at the comps. What kind of properties are standing out? Which ones are the top performers? What amenities do they have? What kind of design do they have that's doing well? Which would say those numbers are that way because that's what the travelers there want the kind of amenities they want, the kind of design that they want. So check your bias. Don't just, design the place how you feel you would want to make it look if you were staying there for a trip, especially if it's a market that you are unfamiliar with and numbers have pointed you there.
Awesome. Cool. And yeah, just kind of on that point of the repair cost, unfortunately, people don't look after their own stuff. People don't look after other people's stuff as much as they look after their own, right? So expect extra wear and tear on your furniture and your walls and everything else. Fortunately.
100%. Yep.
Cool. So I did have one more question. I'm going to save it till the end because we've already got a bunch of questions in the Q&A. So let's go over to some of those from our attendees. Also a reminder, folks, for anyone that hasn't spotted it, you can use the Q&A functionality at the bottom of the screen to kind of submit a question. You can also raise your hand if you prefer to ask on stage. So let's get into these questions that are lined up. So first question is from Ben, and basically he's asking, what are your requirements when lending for short-term rentals? So I think that's specifically to Host Financial. A broad question, but if you can delve into a little bit on the requirements there.
Sure. I mean, so the approach that we take when we're, underwriting or lending to a short-term rental is essentially we're going to take whatever that actual or projected income for that subject property is and use it to underwrite the loan. We're calculating what's called as a debt service coverage ratio. It's essentially taking the income of the property, again, either actual historical income or projected income through sites like AirDNA or Rabu. And we're dividing it by the cost of the financing. So the principal, the interest, property taxes, insurance, HOA fees. We generally look to see a minimum debt coverage ratio of a 1.0, just meaning that the income of the property is at least equally covering the cost of the financing. Now, in practice, most of these short-term rentals are far above that. Most investors don't get into a specific investment just to break even, which is what a 1.0 debt coverage ratio would be. So they're looking for it to be cash flowing some significant amount above that. So some of the best STRs that we see obviously are far in excess of that. I mean, you'll see 1.5, 2x debt coverage ratios on some of the better investments. So that's one. Generally look to see a FICO score of 620 or higher. Obviously, the higher your FICO score, the better the pricing is going to be. And then we'll also look at experience level of the investor. So if they own other STRs, have experience managing them, or if this is their first one, that'll play into the underwriting as well. That's kind of high level what we look for on any short-term rental.
Cool. Thank you. Thank you, Ben, for that question. I see Ben has submitted a couple actually. So I'll ask you one more from Ben. So are these loans considered commercial or residential? How is the value of the business calculated? Are you providing, sorry, there's a bunch of questions in one. Are you providing bridge/renovation loans? If so, for how long?
Gotcha. Yes. So what was the first one? What was the first part of that question?
Are these loans considered commercial or residential?
Yeah, they're commercial business purpose loans. So I get that answers the first part of the question. These are not conforming loans, like they're not meeting Fannie Freddie type guidelines. I think the second part is evaluating the business is a good question to bring up. When we're appraising the value of any short-term rental, the property itself, the value of that property is based on other comparable properties. It's not based on a cap rate, a capitalization rate on the income that the property is producing. We can use the income to underwrite and qualify the loan, but you're not going to get a higher valuation of the home itself just because it has history operating as a short-term rental. That's a common misconception that we encounter is people assume, they buy a $500,000 house, start generating $250,000 in revenue, that they can then sell that for a higher rate, and that's just not the case.
You might be able to sell that, but you're going to make it.
You might be able to sell it to another investor for a premium, but
and they're either going to come in cash or they're going to be able to get a mortgage on the value of the home based on the sales comps, and then you'd have to do a second deal, whether if he does like a business loan or all cash deal for your book of business and the listing itself.
Yeah. The reason being is any lender is just going to value the real estate based on what other homes, regardless of whether short-term rental, primary homes, whatever comparable products or comparative properties are trading for. Because in the event of a default and a foreclosure, lenders aren't in the business of operating short-term rentals. So they're just going to go out into the market and sell it like a 4-bedroom, 4-bath home. And the fact that it has operated as short-term rental is not going to come into consideration. So it's an important thing to know.
Yeah, and in regards to bridge renovation loans, we do that. Bridge loans are essentially renovation loans. We also get a lot of questions lately about bridge financing, so I just want to speak on that a little bit because I believe a lot of people have been inquiring about bridge financing due to our rate environment. For those that don't know, a bridge loan is typically a short-term interest-only 1 to 2 year loan. You can use it for a purchase. And a lot of people are using that now with the idea that I'm going to buy it. I don't want to skip out on a deal, but I also don't want to be locked into a fixed mortgage that, is at a high rate for a long time. So people will take on a bridge with the plan of refinancing in about a year or two, and they expect rates to come down. And in our response to that, we do have bridge loans, but we also have what we've created a product called like a flexible bridge program. So basically, it's still a 30-year mortgage with a 5-arm, so a 5-arm adjustable rate. However, we've shortened the 30-year mortgage's prepayment penalty to be, you could be a 1 year, 2 year, no years. So it's essentially a glorified bridge loan where you have all the benefits of the bridge, and being that you can get out of it real quick when rates drop, but also doesn't have the downside of a balloon payment within a year or two. So you don't have that worry of, maybe rates don't come down and then you don't have an exit strategy, whether through selling or refinance.
Okay, interesting. So I think that probably kind of lends us to one of our next questions, and that's kind of comparing Host Financial versus kind of like a standard bank business loan, and the pros and cons there.
Yeah, so most, I guess, banks or traditional lenders, they tend to just be a lot more conservative in their underwriting. So, we've got a lot of clients that have success working with some regional banks, some community banks on some of their STRs, and their rates are obviously better. Like typically, that type of regional bank or community bank or credit or local credit union, their rates will be a little bit lower than kind of what we're providing. But the problem they also have there is that they will run into concentration limits with a borrower. So they might be able to do the first 1 or 2 or 3 deals, but eventually that bank is going to make the decision that they've got already too many loans outstanding to this one borrower, and they won't be able to continue to do more deals. The nature of these type of loans is they all get securitized and sold on the secondary market. So there isn't that same concern with an individual borrower about getting that concentration restriction that a bank may have. And just banks in general, they move slower. Their underwriting is a little bit more in depth. They're going to take probably a closer look at your personal finances. Whereas these type of debt service coverage ratio loans, it's a lot simpler. It's really just cash flow of the property, doesn't meet the financing requirements. And then we'll be looking at the borrower to confirm they've got the cash to close, obviously checking credit, verifying entity docs and things like that. But that's really the extent of the underwriting.
Okay, awesome. And then complete change of pace, kind of a broad question. Host Financial purely focused on the US. Vladimir is asking if you can help him in the EU. I think it's a no on that.
Yeah,
that's a no, unfortunately now, but maybe in a few years we'll see. Currently, it's all states except for North Dakota and South Dakota. And truth be told, I don't think anyone has inquired with us about those states. So
I've had a few.
You've had a few? Well,
yeah.
There we go.
But also,
we just checking through the chat now for any Dakotas.
Yeah, it's just the
DC, yes, Andrew,
yes, but cannot do Puerto Rico or the Virgin Islands or any other territories.
Okay, cool. Good to know. Thank you. So the next question. You've kind of touched on this, but Andrew asked it, so I'll ask you and see if there's anything you can add. Can you give a comparison between traditional financing and the financing you're working with? So just kind of a broad overview in case Andrew's missed that.
Yeah, I mean, a lot of more traditional lenders, like if you think like your Wells or Chase or guys like that, when they're evaluating you for a second home or another investment property, they're likely going to look at your personal income. They may be able to do a hybrid underwriting where they're looking at part of your personal income, but also looking at the property income. So big picture is that the document and underwriting requirements are a lot higher. They're going to be a little bit more subjective in their underwriting, and their rates will probably be about a point, maybe 1.25 points below what the DSCR rates if you can get that more conventional type financing. But yeah, it's a much more difficult underwriting process and qualification process. Yeah.
Thank you very much. Thank you for clarifying that. Just taking a step back and talking about, US focused, we have a Canadian in the chat that's asking, is it possible as a Canadian to qualify for an investment in the US? So the properties in the US, but they're in Canada, I assume. Yeah, for sure. We can work with foreign nationals. It'll kind of come down to the type of foreign national you are, whether you have there's various different types of visas that are treated differently than someone that just doesn't have any of those type of visas or documentation. They're just purely a foreign national investor. But yes, we can work with foreign national investors for properties in the US.
Yeah, and then the great thing too about these loans is you can form an LLC and partner, and if you have a 50% ownership of an LLC, with the other half being a U.S. citizen with U.S. credit, that would be even easier. Probably even give you better terms. If you're already in the partnership space, great, and if not, maybe consider that as well. If you don't have the the visa status.
Okay, cool. And sorry, you kind of touched on LLCs there. There was a question around. Do you exclusively lend to companies, or is it also individuals as well?
We do companies and individuals. I would still say, though, that regardless of the optionality of choosing both, most of our investors choose the LLC route for several reasons. One, you're operating short-term rental, which there's a lot of liability involved. So you want to have a strategy of, one LLC per property to protect your other investments from anything happening in this property. Also, as you begin to scale, they have what they call as ambulance chasers, people, wanting to see what assets you have, what they can come after. So identity protection is another reason you'd want to run with an LLC. And then as well as someone is calling, your debt to income ratio. So there's a lot of things that you want to finance in your personal life. Maybe it's a boat, maybe it's, a car, maybe it's just a true second home or your primary home. And when you invest with an LLC, it's associated with an EIN number, not your social. So it's not reported to your credit, or it's not supposed to be. I've seen a few instances where there's been errors in reporting. But typically it's not supposed to show up on your credit. So that's why you can maintain your DTI with things you want to, use to finance the personal things in your life. And then with this, form the LLC, take out the loan and under the EIN and avoid that hit to your credit and your DTI.
Awesome. Sound advice. Thank you. So feel free to take a drink of water, guys. There's plenty of questions. They're coming in thick and fast. So next up, we've had this from a couple of people. I think it was John and Ben. Do you require guarantors on the loan? So
yes,
personal guarantees. Yeah.
Yeah, all these loans are recourse will require a personal guarantee to anybody that owns generally more than 20% or more of a borrowing LLC or borrowing entity rather.
Cool. And then so are you guys Andrew asked this, sorry, are you mortgage brokers for this specific financing? Question.
Both, yeah. So we kind of operate in a hybrid capacity. We've got some facilities that we're able to direct originate under, as well as partner with other capital in the space. We've been in the short-term rental space for 18 years, so we have a lot of relationships on the wholesale side with a lot of these other different lenders that are out there. Which is really the unique thing that we're able to really provide our clients, is that we really have a full cross section of the debt market at any given point. So we're able to make sure that all of our clients, whether it's through facilities through us or through a wholesale channel from a different capital partner, are getting the best possible rates and terms that are available at any given point. Because as I'm sure we're all aware, like it's a very dynamic rate environment. Everyone's changing, increasing, decreasing rates and terms constantly.
Yeah. So with our cross section, the whole point of that was to be kind of the one-stop shop for this type of financing for the short-term rental investors. So if you come to us, you're going to find the best rates because we're quoting literally the entire market. And then in addition to, I know kind of broker on our broker relationships, I prefer to call them wholesale. Broker has some sort of a negative connotation, but really a lot of these lenders have the retail channel, which is, their own salespeople, and then they have the broker channel. They prefer to work with their broker channels because, the brokers have the experience, they come and know the process ahead of time, and there's less hiccups, less costs involved with the labor of managing that relationship. So they never want to cannibalize that channel, right? So, if you come through us, for example, we push a lot of volume to, our broker wholesale relationships. So we get preferred pricing on some of our relationships where the retail channel, if you went direct, they'll give you a 15-day rate lock out the gate. But with us, they'll give a 35-day rate lock. So you have an expert when coming to us, especially on these relationships that know the process, have the weight to throw around to get things done, and then also some better terms and features on the loan.
Oh, okay. Thank you. So the next question is from Larry, and kind of going back to kind of broader tips. What challenges do you see from going from your first short-term rental to your second and continuing to scale up? So we obviously broadly talked about some challenges that people face in financing and some stumbling blocks, but are there specific challenges when you're kind of growing, going from having one property to multiple?
Well, I mean, as far as it relates to financing, I mean, I think it's going to be acquiring the next down payment and capital to buy your second deal and then continuing to roll that forward. But also separately from that, I think, there's just going to be some learning curves, especially if you're jumping in on your first property. There's just, it's going to be a new investment endeavor that you're not really that familiar with. So you're going to have some stumbling blocks, and there's going to be, some kind of trial by fire. But that's why groups like this are really, really helpful. Organizations like Hospitable and the communities that are created in this short-term space. There's a lot of knowledge share that goes around on these online communities for short-term rental investors and hosts that really help kind of give you a head start. If this is your first property, you can really leverage off all the available knowledge that's out there for free in the space. And what I found is what's kind of great about the short-term rental industry is there's a lot of, desire to help and teach and learn and share knowledge. And it's not a very closed off and hyper competitive, this is my secret, I'm not going to let anybody know how I figured it out type of space.
Sure. Yeah. There's definitely a wealth of knowledge out there online. Sure. Cool. So next question. I feel like I know the answer to this, but I'm going to ask you anyway. Jenny asks, do you provide financing for arbitrage or purchasing only?
Not for arbitrage. It's just for the purchasing of the property itself. So we also don't do like furniture financing. We can't finance that. It's really just the acquisition or the refinance of the residential real estate.
Cool. Okay. Thank you. That is the answer that I thought, by the way. So cool. So John asked, because you kind of touched on bridge loans, it being, I think you said that it was interest only. Generally for your loan program, is it interest only across the board?
We can do both. We can do full amortization. We can do interest only. It really depends on, what your objectives and goals are. So that's another thing that we really, try to pride ourselves on is when we, talk to any of our clients. A lot of people may not be as intimately familiar with all the different financing options and loan options. Obviously, it's like Dan and myself and our account executives that deal with this day in and day out. So what we really try to understand is what their objectives are. If somebody, says they want to acquire the property, they want to get it operational, stabilized, and they plan to get rid of it, sell it, or, dispose of it in like a 3-year window, then we can help kind of structure the loan to make sure that we're, it's meeting their objectives as well as possible.
Yeah, fantastic. And then I have a feeling the answer is going to be it's specific to each individual, but we do have people asking what your rates are currently today, or where we can go and find those essentially.
Yeah, it does definitely depend on property type, location, loan size, FICO score, debt coverage ratio, a bunch of different factors. But generally it's like mid-high 7s to low mid-8s for a broad section.
Yeah, that's a broad section at trying to achieve the highest amount of leverage. Base rates typically around 6.75, but really not everyone's coming in trying to put 50% down on a property with good credit.
Yeah. Cool. Yeah, that's right. That's for the maximum leverage is generally in that range.
Nice. Okay. Thank you. Very difficult to give a very specific answer on that. So appreciate the kind of the broad ballpark there. So Manny asked the question, do you provide loans on commercial units, for example, 5+, and is the value of that property determined on traditional commercial loans, such as NOI and cap rate to determine the valuation?
So yes, we can lend on 5 to 8 and even 9 and above number of units. The value of that, call it 5 to 8 property, it's still going to be determined by the appraiser, and they are still going to determine it based on a traditional market rental NOI cap rate basis. But we can then in turn use the higher short-term rental income to underwrite that new loan to qualify it. But the value of the real estate will still be determined by the appraiser, and it'll still be determined on a traditional commercial appraisal basis.
Cool. That's it. And then In fact, I'll ask this question from John, just as we're going to finish up topic. What's the typical, and again, I'm sure it changes, what's the down payments for 1 to 4 units and, versus kind of 5+ units?
Yeah, again, it's going to vary based on a lot of those factors, but down payment from 1 to 4 can be 20 to 25%. Anything 5+, you're solidly going to be putting 25% down.
Cool. Thank you. And then we kind of touched on this question before as well, but so there's kind of 2 questions here. So for long-term rentals, can we purchase a distressed property at auction and get financing for renovations? And the kind of second part of that is someone again asking about loans for kind of furnishing a short-term rental as well. So asking you that in 2 parts there.
So loans for furnishing short-term rentals, we can't do that. But for acquiring distressed properties and renovating them and, improving them and then increasing the value, yes, we can provide those. Those are commonly referred to as renovation loans or fix and flip loans. We provide those all the time, and that'll allow you to acquire the property. There'll be some amount of budget that's built into the loan to kind of do those improvements. And then the intention would be to refinance you out after you've increased the value of that property.
Yeah. And in terms of furnishing your property, I mean, SBA loan, take out a 0% credit card if you can. We have partners that, will underwrite or will give out a loan based on the projected future cash flow of other real estate investments that you have. I'll put in a link to the website here. It's Nectar is the company. Very innovative product. You can use the projected cash flow from your other properties to collateralize against their loan and use it for down payment assistance, funding your furniture, doing upgrades to your property, buying a tub for your property, things like that.
Cool, fantastic. Yeah, we'll drop that in the chat. That's a useful tool for everyone to check out. And then there's been a bunch of questions on it. So just generally, people wanting to understand a bit more about underwriting. So documentation required for underwriting, and then also talking about underwriting for short-term rental income to offset the long-term rental appraisal if they come in low.
Okay, so documentation, we can take that pretty quickly. So obviously, if you're going to be buying a property, we're going to need a purchase contract, copy of the earnest money deposit, entity docs. So if you're investing to an LLC, we'll get the articles of organization, operating agreement, EIN letter. For the short-term rental income, it's going to depend on what kind of income we're underwriting with. If it's got historical income, we're going to get that trailing 12-month income statement. If it's a brand new property, we're going to pull an AirDNA report or RABU report or something like that and use that to underwrite. And then from there, it's bank statements on the borrowers to confirm that you've got the necessary cash to close and reserves for the property. And then title and insurance docs. And for the most part, that's the bulk of it. And it'll change. There'll be a few other things here or there, depending on the type of transaction you're doing, or based on the underwriting of the borrowing entities. We could get a couple more stipulations for a few different items, but that's basically the bulk of it. And then I forgot the second part of the question.
No, I'm gonna have to scroll back up myself. So we talked about documentation. So Elena asking about underwriting for STR income to offset long-term rental appraisal if they come in low.
I think I understand what.
I'm not sure I understand that question.
Correct me if I'm wrong, but are you saying in the scenario that I think she's saying in the scenario that they're underwriting qualifying off market rents and say that doesn't come in where it needs to be on the 1007 market rent survey, what's the documentation for underwriting and switching to short-term rental income? I believe if you can tell me if that's right in the chat. But if that is the case, then it's simply an AirDNA report. And you would want to know based on your lender or based on the program if they're taking 100% of that, 90%, 80%, or 75%, because that could change. And then also, this fits right into we're writing an article for Bigger Pockets right now, discussing this same thing about how to shop for lenders and how underwriting works. And if you're going to work with a DSCR lender for short-term rental financing, make sure that they can underwrite with short-term rentals, because If they operate with underwrite with short-term rentals, or they can an AirDNA report, then they can definitely do it with market rents as well. But the reverse is not always true. So if they can underwrite with market rents, not all of those lenders, I'd say most, don't acknowledge short-term rental income. So to ensure that you have the full suite of, income underwriting capabilities, make sure that, first and foremost, they can underwrite your short-term rental with, that sort of income.
Yeah, I mean, it's an SOP on our side. Every deal that comes in, we automatically pull an AirDNA projection and check to make sure that that the deal is going to qualify based on that income stream. And then from there, you've got other options. Like Dan said, you could look at the 1007 rent, you could look at actuals, but we always, just as a matter of process, pull an AirDNA report on every property that we're underwriting and taking a look at to confirm that we've got that option to use, should it be necessary. Yeah.
Cool. And then we kind of touched on DSCR loans there. There was a question from Tori around, can you do that for raw land and then use a construction loan to build from the ground up? Is that something that you see people do?
So yeah, it's probably just DSCR loans can't be used to acquire raw land because just by the nature, they're not producing any income. But we can fund a construction loan to acquire raw land to then build on it. But it's not a DSCR loan. That's going to be that renovation, construction, bridge loan. It's going to acquire the property, provide loan budget to either build or renovate, and then the intention is that completion of the renovations or the new construction, you refinance out into the DSCR loan at that stage. So you'd have to use two different loans in that scenario.
Nice, yeah, and I think that's answered a couple of people's questions around if construction loans are possible. And obviously,
they don't convert. They're two separate loans. You do a construction and or renovation loan to do the new construction or the renovation improvements on the property. Once those are complete, then you refinance into the DSCR loan. So two separate loans, two separate processes.
Cool, perfect. Thank you very much. I lost who asked that question, maybe Tori. So thank you very much for that. Then just time for maybe one or two more. So Ronald was asking about seeing people on social media that seem to be growing their portfolios very fast. Ronald is stuck at two properties, two short-term rentals. He's trying to understand how people get these down payments to grow. When you're seeing rapid growth in the market, what are those people typically doing to get there?
I think it's kind of a snowball effect. As you get two, the cash flow that's going to start building up. You're going to get three. The next thing you know, that three is going to build up the cash flow quicker for the fourth, and so on and so forth. And then also leveraging OPM, other people's money. So you can form, with LLCs, partnerships. And if you're the mastermind, and you're the one that knows the market, knows how to execute, you might get a premium on your equity split, with the GPs, or you're just the GP, meaning general partner. And then you have limited partners that pitch in money for the down payment. Maybe it's small enough ownership percentage that they're not a guarantor. A lot of LPs don't. But, I've seen a lot of people put in an even amount of money, but they ended up with 30% versus everybody else's 10 or 15, because they're the mastermind behind the investment. They're the one that's going to ensure that everyone gets the returns.
Yeah, and just like Dan's saying on the snowball effect, once you've proven that you can execute on the investment concept, so your first and second one, it's a lot easier to go out and raise money when you've got actual figures and metrics that you can point to and share with any potential investors. Be like, hey, I've done this twice. Here's how they're performing. I want to go do it a second, third, fourth, fifth time. So it is a little bit of it's a little bit of a steep climb to get to that initial point where you've done a proof of concept, but then it can kind of start snowballing downhill as you start to pick up some investors for the third and fourth and fifth, and from there it just continues to grow.
Cool. So I take it, if you already have two properties, whether they're in the area or not, you can use that as kind of proof of income numbers for kind of underwriting as well, to kind of show, like you said, you've not proof of income, but you've done it before.
It's more so for raising investor capital. I mean, we can't take the income of property A, and that property A is doing 150,000, and apply that to a different property across the street. It may be the exact same. I mean, we've seen this in condos too, exact same floor plan, owners own floor plan A, floor plan B is exactly the same. You're still going to want to look at that AirDNA report or that projected income report on whatever the subject property is. So I was more speaking towards the ability to raise
your experience with other properties. It's more of like a binary on-off switch that could open up or close off loan parameters or loan terms for you. So there's some programs in which, if you do have a property already in the market with 100 miles, or you have experienced one or two properties in general nationwide, we might be able to use 100% of the projections, versus if you're new, we might be able to use in some programs 80%, take an 20% haircut off that projected income and use 80% to underwrite. So that's how the experience could be affected in terms of the underwriting of the loan. But we can't, we can use the cash flow in any sort of actual means to underwrite it.
Yeah, sure. So it's more just the more properties you have, the more cash flow you have, which is easier for you to get the funds together for a down payment as much as anything else, right?
And some additional ways to think about, or if you're going to search for properties, and maybe an AirDNA report doesn't always cover, maybe market rent doesn't always cover it. You can find sites like Revdy, AirDeed. We'll send out some resources to everybody later, but if a property has already been ran as a short-term rental, we can use that number as well. So maybe the AirDNA is low, but whoever was operating before has a higher number. We can use 100% of that number to underwrite, because it's an actual piece of data for that specific property.
That makes sense. Cool. So I think we're going to have to start drawing to an end here. One final question from me before we kind of wrap up on this. Two questions. I lied. So first off, if folks have more questions that we've not managed to get to here, where can they go to get more answers, and where can they kind of go and learn a bit more about Host Financial?
Yeah, they can go to www.hostfinancial.com. All of our social medias are at Host Financial. You can email myself or Adam, which is Daniel@HostFinancial, or Adam@HostFinancial. That's HOST financial.com.
Perfect. Thank you. And then second question, any kind of parting words of wisdom to kind of sum up here, if we wanted to grow, what's the best way to look at, getting financing to grow? And what are some of the fundamentals that we should be doing to kind of get on your radar and get approved essentially for some financing?
I mean, if depending on where you're at in your investment process, it's always good to, kind of get all your ducks in a row, at least related to what any lender is going to be looking for. So, start putting together your entity docs, make sure you've got your bank statements figured out. Obviously, if you have any dings on your credit, you're going to want to try to address those as soon as you can, because the rates and terms are very heavily affected by the FICO score. So those are some things you can kind of start doing to prepare. And then from there, I would say, if you're actively looking for an investment property, just starting to really understand that market that you're in. Like Dan said, looking at whatever the top performing properties are at these various aggregation sites, joining the various different groups and trying to understand what's going on in that market. I think it's, an invaluable investment in various of these data tools that provide you all that kind of granular insight. I think it's well worth the cost to get those services to really understand the market you're going into and the different drivers that are there.
Yeah, I would say also use the revenue tools as guidance, but it's not always 100% accurate. Do your due diligence, check as many tools as you can. Once again, network with other operators in the, get some actual data, actual feedback from other investors in the area, go to networking events. But don't expect the projected tools to be the truth, in the 100% truth. It can be accurate sometimes, and sometimes it could be way off.
Yeah, take everything with a pinch of salt, I guess, is probably one of the good takeaways. Cool.
Don't be afraid to compete.
Sorry, what was that?
So don't be afraid to compete. If it's saturated, it just means it's popular. If there's ways to compete, you can figure it out.
Cool, perfect. Thank you very much. Thank you very much, everyone, for attending today. We hope you've enjoyed today's masterclass. If you have, we have another one coming on August 30th, and that's going to be with Price Labs, and that's going to be focused specifically on figuring out pricing for your direct bookings. We will send a follow-up email tomorrow with a recording from this session, some links to all the tools the guys mentioned, and also a registration link for that next event. Adam, Daniel, thank you very much. I hope you've enjoyed today's session. Been great having you on.
Yeah, appreciate it. Great time.
Thank you, everybody.
Cheers. Thank you very much, everyone. Have a good one.